Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Bridging Loans Guide. Bridging loans can be a useful financial tool for individuals looking to bridge the gap between purchasing a new property and selling their current one. They are short-term loans that provide quick access to funds, allowing you to secure the purchase of a new home before you've sold your existing property. Lenders offer varying amounts and interest rates, but generally, borrowers can secure up to 75% of the value of their property with a bridging loan. Understanding bridging loans. Bridging loans are short-term, secured loans that can help you purchase a new property before selling your current one, effectively bridging the gap between the two transactions. They can also be used to raise funds for other purposes, such as property renovation or business financing, but you should be aware that they're generally more expensive than traditional loans due to their higher interest rates and fees. In this guide, we'll look at the two main types of bridging loans, closed and open. Closed bridging loans. A closed bridging loan has a fixed repayment date, usually determined by the completion date of your property sale. This type of loan is suitable if you have exchanged contracts on your current home and know exactly when the sale will be completed. The lender will feel more confident in your ability to repay the loan on time, so closed bridging loans tend to have lower interest rates and fees compared to open bridging loans. However, you need to be certain that you can repay the loan by the agreed date, as failure to do so could lead to heavy penalties and even the repossession of the property used as security source. Open bridging loans. An open bridging loan, on the other hand, does not have a fixed repayment date. This option is more flexible but generally carries higher interest rates and fees. Open bridging loans are suitable if, for example, you're still waiting for a buyer for your current property or if the completion date is unknown. As there is no set repayment date, open bridging loans allow you to repay the loan as soon as funds become available, such as when your home sells or you secure long-term financing source. Keep in mind that both types of bridging loans are usually secured against your property, so it's crucial to have a solid plan to repay the loan. If you can't repay it, the lender could repossess the house source. When considering a bridging loan, weigh the costs and risks against the potential benefits. Speak with a financial advisor or a specialist bridging loan broker to fully understand your options and make an informed decision. Remember, a bridging loan should be a short-term solution, not a long-term financial commitment. Financial implications. Valuation process. The valuation process is a crucial step when considering a bridging loan, as it helps determine the amount you can borrow. The lender will appoint a surveyor to assess the value of the property you plan to purchase. Keep in mind that you will be responsible for the valuation fees, which can vary depending on the property's size and location. It's important to understand that the valuation can impact the final loan amount. If the valuation comes in lower than expected, you might need to reassess your financial plans or negotiate a lower purchase price. Loan costs. Bridging loans can be more expensive than other finance options due to their higher interest rates and various fees involved. The most common costs associated with bridging loans include arrangement fee, a percentage of the loan amount, typically 1 to 2%, charged by the lender for setting up the loan. Valuation fee, as mentioned earlier, this covers the cost of the property assessment by a surveyor. Legal fees, you will need to pay for solicitors who handle the legal aspects of the loan. Exit fees, some lenders charge a fee when you repay the loan in full, however, not all lenders apply this charge. Interest rates, bridging loans have higher interest rates compared to traditional mortgages, making them more expensive in the short term. Before taking out a bridging loan, it's essential to carefully consider the financial implications and ensure that you have a clear plan for repaying the loan. Remember that bridging loans are meant to be short-term solutions, and the costs can add up quickly if the repayment is delayed. Risks and considerations. When considering a bridging loan, it's important to be aware of the potential risks and challenges involved. In this section, we will explore debt management and repayment schedules as two key areas to consider. Debt management. Managing your debt is crucial when taking out a bridging loan. Since these loans are generally short-term and come with higher interest rates than traditional loans, it's essential to have a clear plan for managing your debt. Failing to do so may put you at risk of financial difficulty. To help with debt management, create a detailed budget outlining your income and expenses. This can help you ensure that you have the necessary funds to cover the loan repayments. You should also have a contingency plan in place, such as an alternative source of funds or asset disposal, in case you are unable to repay the loan within the agreed time frame. Repayment schedules. Understanding and adhering to the terms of your repayment schedule is crucial for successfully paying off your bridging loan. You must be aware of the repayment date and any fixed repayment dates that may apply to your loan. Missing a repayment can result in penalties, increased interest rates, or even repossession of the asset secured against the loan. To manage your repayments effectively, consider setting up automatic payments to ensure they are made on time. Additionally, keep track of your loan repayment progress, and actively look for opportunities where you can make overpayments to reduce the overall interest accrued. In summary, managing your debt and following your repayment schedule are vital to mitigating the risks associated with bridging loans. By maintaining a clear understanding of your financial responsibilities and obligations, you can navigate the process successfully and minimize potential challenges. Uses of bridging loans. For auctions. Bridging loans can be particularly useful when you're looking to purchase a property at auction. Auctions often require immediate payment, which might be difficult if you haven't yet sold your current property. A bridging loan helps bridge the gap in funding, enabling you to secure the property quickly. For property development. If you're considering renovating or developing a property, a bridging loan can provide essential short-term funds. These loans are ideal for covering the costs of materials and labor without having to wait for traditional mortgage approval. Since bridging loans can be arranged quickly, they are convenient for those looking to speed up the development process. For landlords. Landlords and property investors can also benefit from bridging loans. If you're looking to acquire a new buy-to-let property, the loan can help finance the purchase until your existing property sells. Additionally, bridging loans can assist with business expansions and meeting tax obligations. Keep in mind that lending rates for these loans may be higher than those for traditional mortgages. It's essential to ensure your financial situation is strong enough to manage the repayment terms. Application process. When you begin the application process for a bridging loan, it's essential to prepare all the necessary documentation. First, gather basic identification documents such as your passport and proof of address. Some lenders may also require evidence of assets and liabilities to assess your financial standing. Once your documents are in order, search for a specialist broker who can guide you through the process and help you find the most suitable loan option. Bridging loans have two types, open and closed, which differ in their repayment terms. With an open loan, there isn't a fixed repayment date, while closed loans have a set time frame. Your broker can help you choose the right type based on your needs. During the application process, the lender will examine 4 key aspects: the borrower, the property, the loan's purpose, and the exit strategy. Your credit history plays an essential role in the lender's decision, as it demonstrates your credibility and ability to repay the loan. Submitting your application forms and other relevant documents to the lender is the next step. The forms vary depending on the lender and your individual circumstances. Your broker can help you complete these forms accurately, ensuring all necessary information is provided. Lenders may also conduct credit checks as part of their risk assessment process. So, it's important to be honest about your financial situation during your application and provide accurate information. This will help the lender in their decision-making process, potentially speeding up the approval and disbursement of funds. Gather identification documents. Find a specialist broker. Submit application forms. Keep in mind that the application process for a bridging loan can be relatively quick and straightforward, especially with a knowledgeable broker's assistance. By providing accurate information and diligently preparing your documentation, you can increase your chances of securing a bridging loan that meets your needs. Alternatives to bridging loans. When considering financing options, it's essential to know that bridging loans are not the only choice. There are several alternatives, and the best one for your situation will depend on your individual needs and circumstances. This section will discuss the primary alternatives to bridging loans, mortgage, remortgage, and personal loans. A mortgage is an option if you're looking to purchase a new property. This long-term financing solution allows you to borrow money to cover the cost of the property, which you will then repay over an extended period, usually 25 to 30 years. This can be a suitable alternative if you have a steady income and can comfortably meet the monthly repayments. However, the approval process for a mortgage can sometimes take longer than for a bridging loan, which might not suit everyone's needs. Remortgaging your current property might be an alternative if you need to release equity to finance another purchase, or repay outstanding debt. This involves replacing your existing mortgage with a new one, usually with better terms or a lower interest rate. Remortgaging can be a cost-effective solution because it allows you to benefit from any increased property value, and use the additional funds as needed. Bear in mind that any improvements in the terms or rates of your new mortgage will depend on your financial situation and credit history. To learn more about remortgage options, view which. Lastly, personal loans are another alternative to consider when you need to borrow a smaller amount of money. These unsecured loans do not require collateral and typically have relatively lower interest rates compared to bridging loans. Personal loans can be obtained from banks, building societies, and online lenders. They can be used for various purposes, such as home improvements, debt consolidation, and in some cases, purchasing a property. It is important to note that the amount you can borrow and the interest rates offered will depend on your credit rating. In conclusion, while bridging loans can be a useful solution for short-term financial needs, they are not the only option. It is essential to carefully consider all alternatives, such as mortgages, remortgages, and personal loans, before making any decisions. Evaluate your personal circumstances and choose the most appropriate financing solution for your situation. Understanding core differences. In this section, we'll explore the core differences between first charge and second charge bridging loans. We'll cover what charges are and distinguish between first charge and second charge loans to help you navigate the world of bridging finance with ease. What are charges? Charges are a way for lenders to secure the money they've loaned to borrowers, typically using property as collateral. In the context of bridging loans, charges refer to the order of priority for reclaiming funds if a borrower defaults on their loan repayments. The higher the charge, the higher the priority a lender has in the repayment process. Understanding this concept is crucial before delving into the differences between first charge and second charge bridging loans. First charge vs. second charge. First charge bridging loans. A first charge bridging loan is secured against a property with no existing borrowing, or it takes priority over any existing mortgage or loan. This means that in the event of a default, the lender with the first charge has the right to recover their funds first, before other creditors. This type of loan is commonly used when buying a new property before selling the current one, or when refinancing an existing property without any borrowing. Some key points about first charge bridging loans are: they take priority in repayment. Used for new property purchases and refinancing. Lower risk for lenders. Second charge bridging loans. A second charge bridging loan is secured against a property that already has a first charge in place, typically a mortgage. In this case, the second charge lender holds a lower priority and will only reclaim their funds after the first charge lender has been repaid. These loans are generally riskier for the lender, as they may not recover their full investment if a borrower defaults. Some key points about second charge bridging loans are: they have a lower priority in repayment. Used as additional finance for property investments. Higher risk for lenders. By understanding the core differences between first and second charge bridging loans, you'll be able to make informed decisions when considering short-term borrowing options for your property-related needs. Remember to always consult with an expert before making any financial decisions, and carefully evaluate your options in light of your specific circumstances. What is the procedure for obtaining a bridging loan? To obtain a bridging loan, you'll first need to approach a lender or a broker. They'll help you understand the requirements and the application process. You'll need to provide details about the property or asset involved, as well as your repayment strategy. After assessing your application, the lender will make a decision, and if approved, the funds can be released quickly, sometimes within days. How do interest rates vary between different bridging loans? Interest rates for bridging loans can be either fixed or variable. They depend on factors such as the term of the loan, the property's value, and the borrower's credit history. It's essential to compare various lenders and their rates, as they can vary significantly. Keep in mind that bridging loans typically have higher interest rates than traditional mortgages due to their short-term nature. What are the primary uses of a bridging loan? Bridging loans are primarily used to bridge the gap between the purchase of a new property and the sale of an existing one. They can also be used for a range of other purposes, such as property renovations, purchasing at auction, or making quick acquisitions of undervalued property. These loans provide short-term finance when time is of the essence, allowing property transactions to proceed without delays. How do bridging loans compare to mortgages? Bridging loans differ from mortgages in several ways. Firstly, they are short-term loans, typically lasting between 1 to 24 months. Secondly, interest rates are usually higher than mortgages due to the increased risk for lenders. Lastly, the underwriting process for bridging loans is much quicker than traditional mortgages, enabling you to receive funds faster. While mortgages are designed for long-term financing, bridging loans cater to temporary financial needs in property transactions. What are the common criteria for eligibility? Eligibility criteria for bridging loans can vary by lender but generally include having a clear repayment strategy, such as the sale of a property or a long-term finance solution. Lenders will also assess the value of the property or asset involved to determine loan-to-value ratios, LTV. Your credit history and overall financial stability will play a role in the lender's decision. It's essential to understand the specific criteria required by your chosen lender before applying. Are there any alternative options to consider before applying for a bridging loan? Before applying for a bridging loan, it's worth exploring alternative options such as remortgaging, personal loans, or extending your current mortgage. Each option has its advantages and disadvantages. It's essential to weigh up the pros and cons and consider the costs and risks associated with each before deciding. If speed and flexibility are critical factors for your property transaction, a bridging loan may be the most suitable option. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.